Most traders make scalping harder than it really is. But the truth is, it doesn't have to be stressful or confusing. Imagine using one simple strategy that helps you make consistent profits in just 30 minutes a day without sitting in front of the screen all day. This is the same 1-minute scalping strategy I use to make over 6 figures a month. There's no guesswork, no complicated indicators, and nothing extra you don't need. I'm not just going to explain the theory. I'll guide you step by step, and at the end, I'll show you real, back-tested results so you can see for yourself that it works. Let's get started. Let's break it down into 3 simple steps you can use every time you trade. Step 1. Identify the break of structure. We will only use 2 time frames. The 15-minute chart will be your higher time frame. The 1-minute chart will be your lower time frame. Keeping things simple is the most important rule. When your plan is clear, you can take trades without hesitation or fear. The first thing you need to do is look for a break of structure. A break of structure simply means that price has broken above a previous high or below a previous low. We always trade with the market's direction, not against it. If the market has already shown you where it wants to go, your job is to follow it. For example, if price breaks above a previous high, this is a bullish break of structure. That means the market is moving upward. If price breaks below a previous low, this is a bearish break of structure. That means the market is moving downward. Once you have found a clear break of structure in one direction, step 1 is complete. Step 2, define your point of interest. Your point of interest is the area on the chart where price is most likely to react. A point of interest can be a supply zone, which is an area where sellers are strong, a demand zone, which is an area where buyers are strong, an order block, which is the last candle before a big move, a flip zone, which is an area that switched from support to resistance or from resistance to support, or any zone where liquidity was taken, meaning price grabbed stop losses before reversing. Once you have found your point of interest, wait for the price to come back to it and react. When it reaches your point of interest, move to your lower time frame, the 1-minute chart, and look for your entry setup. Here's a tip for beginners. The 1-minute chart is very fast and can be hard to read. If you are new, use the 5-minute chart instead for entries. It is slower and easier to manage. But if you are experienced and can read price action well, the 1-minute chart gives you very accurate sniper-style entries. Step 3. Look for the entry model. When price reaches your point of interest, drop down to your lower time frame and watch for liquidity. Here, liquidity is sitting just below the higher low. The market comes down again, breaks structure, and then starts moving up. Now, this low has become our new point of interest. The market then breaks the previous high, giving us a clear change of character. This tells us the market has turned bullish. Now we simply wait for the price to come back to our point of interest. When it does, we get a clear sniper entry. Before looking at examples, let's first understand where liquidity is usually found. Equal highs or equal lows. If price forms equal highs, it means many traders are selling there, with their stop losses sitting just above those highs. Smart money or big institutions push the price slightly above those highs to hunt those stop losses. This collects liquidity. After that, price often reverses in the opposite direction. Just above a swing high or just below a swing low, if price creates a clear swing high, retail traders who sell at that point usually place their stop loss just above it. Similarly, for a swing low, buyers place their stop loss just below it. Institutions push the market just past that swing high or swing low to trigger these stops and grab liquidity. Once liquidity is collected, the market often changes direction. Obvious support or resistance break example. When the market has a strong support or resistance level that everyone can see, a lot of orders pile up just beyond that level. There is present liquidity. Let's move to the charts and see some real examples so you can clearly understand how this works in real time with candlestick charts. Right now we're looking on the 15-minute time frame. We can see that there's a bullish break of structure going upward. That means we should be looking for buy setups at demand zones that cause this break of structure. So, we start marking every demand zone that led to the break of structure. We can begin from the extreme point on the right. That's the extreme zone. Then, there's another zone here, once you mark your points of interest. So the question is, how do you know which zone price will react to? The truth is, we don't. Trading is never about certainty, it's always about probabilities. Our job is to wait for price to enter any of these zones, then look for our entry model. If we see the entry model, we take the trade. In this example, price goes deeper and ignores the first point of interest, so we remove it. Price reacts from another demand zone instead. When price reaches your 15-minute point of interest, you immediately drop to your lower time frame to look for the entry model. First, I check where the most recent break of structure is on this lower time frame. Here it is, which means we expect price to break the last lower high to create a market shift. Let's see what happens. Price goes even lower, so now we draw a new internal break of structure. This gives us a new most recent lower high that needs to be taken out for a market shift, finally moving up and creating the market shift. This tells us the bearish short-term flow is now shifting bullish. We also see strong liquidity being taken. How? Price moved down and formed equal lows, building liquidity below them. Then it dipped to sweep these lows before pushing up sharply. Now we have both a liquidity sweep and a market shift. The next step is simple. Wait for price to pull back to the most recent lower time frame demand zone that caused this market shift and enter there. Once price taps the point of interest, we enter. Stop loss goes below the zone. Target always take minimum 1:2 and above. For this strategy, we always take profit at 1:2 to keep risk consistent. In this case, price hit our 1:2, take profit. That's how mechanical it is. Wait for price to pull back to your lower time frame point of interest, then enter. This is the reality of trading. You might lose 1%, then win 2%, ending up positive overall. It's not about how many wins or losses you have, it's about keeping losses small and wins bigger. If you have small capital, get funded. Bigger accounts make bigger profits with the same strategy. Thank you. See you in next strategy.